Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, the Federal Reserve met for their last meeting of the year. Fed Chairman Jay Powell held his normal press conference afterwards and said things that caused Wall Street to sit up and take notice. What did he say? It was a great week on Wall Street with the Dow Jones hitting new all-time highs. So is this the so-called Santa Claus rally, or is there even more in store? Tonight, we're going to be talking with Sebastian Page. He is the Chief Investment Officer at T. Rowe Price with just under $430 billion of assets under management. And we'll ask him if this market rally will continue, and does he see more in 24? So stick around for the next 28 minutes. This is Wall Street Wrap-Up. Hi and welcome. I'm Andre Laborde. What a week in the stock market. On Wednesday, the Federal Reserve had their last meeting of the year to decide to either raise, pause, or lower rates. Well, the consensus on the street was that they would not raise or lower, but pause, which is exactly what they did. The rates that the Federal Reserve charges banks will stay at 5.5%. or how it's referred to as 550 basis points. But was just as important is the press conference afterwards that the chairman of the Fed, Jay Powell, had, where he said that they now will be looking to lowering interest rates a possible 3 times for next year. Now, he did leave the option open depending on the data, but with that statement by Powell, the stock market took off faster than one of Elon Musk's SpaceX rockets. The CPI, or Consumer Price Index, was released this week. For November, it did show a reduction in overall inflation at the consumer level for the year, now at 3.1%. Month over month, the inflation hitting the consumer was up 0.1%. But as they say, the trend is our friend because it shows a trajectory down. Core CPI, which is taking out the volatile food and energy for the year, is higher at 4% annually. And coming up, J.P. Morgan has released their top internet stocks for the year, and we'll tell you what those picks are. But first, how did our money do this week? Well, for the week, the pops were technology, communication services, and staples. And the drops were financials, healthcare, and materials. And the Dow Jones hit an all-time high this week with J.P. Morgan, Boeing, Costco, and Intel hitting 52-week highs. And the losers were Johnson & Johnson, Pfizer, McDonald's, Verizon, and Goldman Sachs. This week, Dow Jones closed today up for the week at 2.8%. The S&P 500, they closed up today just under 2.5%. And the NASDAQ, they closed for the week also up 2.8%. J.P. Morgan's head internet analyst, Doug Anmuth, just released their top internet picks for next year. And they are Amazon, Alphabet, or Google, and Uber. And by the way, as a reminder, Uber, starting this Monday, coming up on December 18th, is going to be joining the S&P 500. He also said to expect internet outperformers primarily driven by larger mega-cap internet companies. Many investors are hoarding cash, waiting for a time to get back in. So when is that time right? And is this the time? Since the beginning of the year, the stocks that are known as the Magnificent Seven, they have fueled the S&P 500 to higher highs. New CPI numbers being released this week, and the Federal Reserve pausing of interest rates at 5.5% is affecting the consumer with higher rates from everything from a 30-year home loan to used cars. Credit card delinquency rates are now just under 3%, which is almost double from what it was 2 years ago. So with the holiday shopping season in full swing, how is the strength of the consumer? The Wall Street Journal says that strength of the consumer has been strong this whole year. Now tonight, we're going to be talking to Sebastian about all these questions because this evening we've got Sebastian Page. He is the Chief Investment Officer at T. Rowe Price with just under $430 billion of assets under management. and he's here with us tonight. Hi, Sebastian. Welcome back to Wall Street Wrap-Up.
Thank you, Andre.
Sebastian, I've followed you, and you were for the longest time bearish on the markets, and then maybe about, I don't know, 3 weeks, 4 weeks ago or so, you turned from bearish to bullish. Are you still bullish now on the markets? And if you are, what made you decide to make that move?
So, Andre, we're neutral right now between stocks and bonds in our portfolios. We were bearish in 2022. It felt great because markets were going down, so we were adding value tactically by being underweight stocks. And this year, we've progressively reduced our underweight to stocks, but it wasn't as comfortable to be bearish this year because growth has surprised on the upside. Now, since then, it's interesting because I'll say we've had a November to remember. November was actually the 7th best month in history for stocks, up 9%. So look, we're not short-term market timers. We look at valuations and we invest with a 6 to 18-month horizon in our tactical asset allocation process. But back then, a few weeks ago, end of October, not only were stocks down, but sentiment was down too, which was also a trigger for us because we tend to be contrarian. So, Andre, the bottom line is we had been underweight. We'd been closing it this year, and we finally went to neutral in October. I think right now is not the time to be a hero, not the time to take a big directional positions on stocks or bonds. I like to say stay invested, stay diversified. This is an environment that's too uncertain to take a big position.
4 months ago, 5 months ago, I remember you said you liked high yield investments. And I'm assuming you were talking about high yield bonds, maybe treasury bonds, or other types of that area of securities. Are you still, and by the way, at the time I thought you said, just like now, you said you're looking at about a 16 to 18 month horizon, and that was about 5 or so months ago.
Right.
So are you still with that thought of high yield, which would be bonds?
Yeah, look, it's a great question because while we're neutral between stocks and bonds, under the hood, we see opportunities both in stocks and bond markets to be selectively contrarian. For example, in stocks, we're long small caps at the moment, which is an interesting position because growth is slowing, but it keeps surprising on the upside. And to your question on high yield, we are still long high yield. Now, spreads have compressed and growth is slowing, but we don't expect a hard landing or full-on recession. Our projections of default rates are in line with historical averages. And the beautiful thing as an asset allocator with high yield right now is that we're looking at 8.5%, 9% yield on a global portfolio of high yield bonds. So on the margin, we like that asset class more than treasuries, and that's part of our diversified positioning. Now, I'll admit, spreads have narrowed, so we don't expect phenomenal returns, but at 9%, it kind of gives you stock-like returns with, unless you get a really hard landing, lower risk or lower volatility that you can expect.
We've just got days now left of 2023. For trading, and we're about to go into 2024. And you talked about hard landings as compared to soft landings with recession, possible recession. Do you see a possible recession for coming up into 2024? And depending on how you feel, is there something that the Federal Reserve can do to soften the blow?
Look, there's always a probability, there's always non-zero probability of a recession, but our base case is a soft landing. Look, we're normalizing from very high levels of nominal growth. Andre, I like to talk about nominal growth, which is real GDP growth, the numbers we talk about all the time, plus the inflation component, because it turns out stock earnings tend to correlate with nominal growth more than real growth. So, Andre, 2021, we had 10% nominal growth. 2022, we had 9% nominal growth. This year, it looks like we're decelerating towards maybe 6% nominal growth. And what will we get next year? Maybe 4.5, maybe 5% nominal growth. So we're talking about a good, not great environment. Now you might say, well, why you're not pedal to the metal, full-on overweight stocks relative to bonds? There are risks. The leading indicators have been flashing recession risks for quite a while. I like to say that the most anticipated recession in history has become the most delayed recession in history. But we've had a lot of Fed hikes, 550 basis points, and there are long and variable effects of those hikes that we still have to work through. Andre, consumer debt, credit card debt, people are really, lower wage earners are really loading up on credit card debt. Companies that have shorter term debt, maybe in the small and micro cap area, that is coming due, which means refinancing will be at a much higher rate. That's a risk. Commercial real estate, we know, is really shaky. So these long and variable lags will continue to hang over our heads a little bit and prevent us from going all risk on, sort of convinced we need to overweight stocks. It really is a time for balance.
What about, it's a great point you bring up, Sebastian, about earnings, because we're now toward the end of the fourth quarter, and we're going to start getting the earnings of the fourth quarter as we go into January. Do you think that the consumer with retail stores are hoping and praying that that buying during this holiday season will be brisk? Do you think that it will be good? Do you think that the credit of, like you say, the consumer is they're putting so much on credit cards is going to be having an effect on them during this holiday season?
So here's the thing. I expect the consumer to remain strong. My daughter's 13 years old. She made a really long list for her Christmas presents. I got to say that this is just anecdotal, just anecdotal evidence. But employment data is really strong. People have jobs, and therefore they are more likely to spend than when they don't have jobs. And in fact, the unemployment rate last week, Andre, ticked down, not up. It went from 3.9% to 3.7%. There's also a lot of liquidity. While credit card debt has risen to a level that's worrisome, at the same time, in aggregate, households in the country have really good debt to total asset ratios by historical standard. What's another way of saying that? Is that they have good balance sheet. There's a lot of still money and wealth in the system. There's $6 trillion sitting in money market funds, $4.4 trillion in checkable deposits. Andre, I call it the blob of money. And economists are saying excess savings are running out. But those are adjusted measures for trend and for what is normal saving. And there are other wonky adjustments around them. I just look at the raw data. I just look at the $6 trillion and the $4.4 trillion in checkable deposits. By the way, that number was 1.5 at the beginning of 2019 before the pandemic. 1.5 to 4.4 trillion in checkable deposits. The unfortunate thing is that money, that blob of money, is not distributed equally. And those at the bottom of the wages are struggling more than those at the top. But the aggregate number is healthy. This blob of money is still there. We're working through it, but it's still there. And so therefore, with strong employment, we are looking at a strong holiday season in my mind. So relatively strong consumption. Even last week's numbers in terms of consumer spending came in above expectations again.
With that $5.86 trillion that's sitting on the sidelines, do you think that that money, or a good portion of it, will be seeing itself into the stock market in 2024? Or do you think, like what we're talking before earlier about high yield bonds, where an investor was going, now, okay, let's say CPI is at 3.2%, and I'm getting 4.2%. If you subtract the 3.2 of inflation from the 4.2, I'm okay with 1%, 1.5% in the plus rather than the minus. Or will there be a fear of missing out? What are your thoughts?
So, short rates remain quite high. So you get a good return on that cash. That's why it's there, the center of gravity, right? Over time, the yield curve could normalize. In fact, we're still short duration a little bit. So we're short the longer term bonds. So, Andre, I think the money's going to get deployed, not all of it. There's going to be a lot of buy the dip. In a sense, the October 27th, when stocks were down 10% from their recent peak, that was a little bit of that blob of money being deployed, right? There was a little bit of that buy the dip. I think that could continue and put a bit of a floor under risk assets over the next 12 months. And it will be deployed, in my mind, both in bonds and stocks. And for those risk-averse investors that are closer to retirement, they're going to look at income, and bonds now offer you a higher yield, so higher income over time. So there are opportunities there. But also, I think there'll be some buying of the dip in stocks and investors waiting. People call it dry powder or money on the sideline. This is a big effect. This is there. It's a lot. Even the money market number, Andre, the six trillion, you have at 5.86 trillion. That was 4 trillion before the pandemic. So we have 2 trillion excess in the money market funds. So yeah, I agree with you that some of this is dry powder waiting to be deployed in both stocks and bonds.
Well, last week, as you mentioned, the jobs report, Bureau of Labor Statistics released the jobs numbers, and it came to like 199,000. And one of the things that I didn't notice it until later, Sebastian, was that of that 199, about 50,000, 49 to 50,000 of those jobs were government jobs. And, when it comes to when you're in the private sector, you have to make a payroll. But government, you don't really have to make a payroll. You don't have to make a product. And it can be, talked about whether that the services. But the point is that it's not as far as private. Do you think that the economy is slowing, that more so that because of those 199,000 jobs, 199K, that 50,000 are government?
Look, it's a great question. The economy is slowing, but from very high growth. And so you could say it's normalizing. The 199,000 jobs, look, there is demand for jobs in services, not just government, but leisure, hospitality. And if you've been flying, Andre, all the flights are packed. There is underlying demand for services. The services ISM is still above 50, which means it's an expansion as opposed to contraction. So it's there. The 199 is interesting because it's supposed to be a number that shows that we've only created 199,000 new jobs, and therefore the labor market, the narrative goes, is cracking. I think it's normalizing. I don't think it's cracking. The long run average for new jobs is 130,000. That's more of a sort of normal number. So 199 is still a good number. Even if it's 50% public sector, it's still a good number. And Andre, I'll give you another number. Okay. We're at 8.7 million open jobs. Now, some of these data might not be too reliable. They might be job postings that are there with no intentions of hiring. But the all-time high pre-pandemic was 7.5 million new jobs. So we're still job openings. So we're still over $1 million jobs open, more than the max we had pre-pandemic. And at the same time, the reason why the markets rallied so hard in November and in early December here is that we're pricing in, the market has priced in 100 basis points of Fed cuts next year. I don't know about that. If employment is so strong and wages are growing at 4%, it might be hard for the Fed to cut 100 basis points next year.
Well, and that's a great lead-in, Sebastian, to my next question, because next year happens to be an election year, and as we all know that politicians want to get reelected, and even though I know the Federal Reserve is supposed to be apolitical, they still answer to the Congress, okay? So I'm curious do you think that they'll have, like you say, maybe 100 basis points? Do you think that they should do 100 basis points? And if they're going to err, I know I'm throwing a lot of questions right now at you, but if they're going to if they're going to err, should they err on the side of keeping it at 5.5% and not lowering? because they were so late to the game in raising of rates at the very beginning, what, 2 years ago?
My view is that the Fed is worried that they cut too much too soon and inflation takes off again. And inflation can take off again with an energy shock, which remains a risk. And energy prices and commodities prices are unpredictable, and we have geopolitical risk, and oil prices have been coming down. But the risk is to the upside on oil prices, and that can propagate through other kinds of inflation. So I don't think the Fed really wants to do 100. In fact, if you look at the famous dot plots, they're telling us they'll do 1 or 2. They're about to update those dot plots, and maybe they'll tell us something different. But they're not telling us they're doing 100. The market is pricing in 100. Also, when we say the market is pricing in something, in those cases, it's a distribution, right? So there might be a small risk that we get a lot of cuts, right, if we get a recession, and that comes in the calculation that leads us to conclude that the market is, quote unquote, pricing in 100 basis points. Andre, it's a bit wonky, but there's a risk around that 100 basis points pricing. So the base case is inflation's coming down and employment might remain strong, which is the soft landing. Almost some people will call it the Goldilocks. But the risk for the Fed of going too soon is really what they should be worried about, election year or no election year. So they might just tell us, they might just do what they're telling us they're going to do, right, Rich, is being data dependent, but also kind of careful with not cutting too soon.
Yeah. You brought up about energy, and I remember maybe it was about a month ago, may have been 2 months ago, you had said, and I think I had either read where you said it, but you said where REITs, real estate, and energy were high on your list as far as an investment. But oil lately has been going down. Is now a good time to get into energy because things are selling off rather than buying high and selling low like most people?
Yeah, so we like to lean against the wind, especially when things get stretched. And I think everybody's on the same side of the boat right now that inflation is coming down. And if you look at 1 year so-called break-even inflations, going back to what market is pricing in, they're in the 1.8, 1.9% for the next 12 months. So it's a risk management position where we have a small overweight to a diversified portfolio that we call the real asset strategy, which has energy and metals and mining and real estate companies. So stocks that are in a diversified way, very responsive to an upside surprise in inflation. So we have that in terms of protecting some of the risk in the portfolio that we might just get a surprise on the upside. Put it this way, Andre, I think the probability that inflation surprises on the upside is higher than its surprises on the downside. So we want to hedge part of that.
Yeah. What about you? You talked about the geopolitical, and I remember, again, watching you be in the past, and I think, and I don't know if I have it in this order, but the three things that always concerned you were inflation, the Federal Reserve, and earnings. And like I said, I don't know if it's in that order. But with geopolitical, I mean, right now we've got Israel at war with Hamas. We've got Ukraine at war with Russia. And lately we've had like 85 attacks on our military bases from Iranian drones and such. Does the geopolitical risk ever keep you up at night as to how this will affect the market?
They do. And the problem is that geopolitics typically don't affect the market that much until they really do. Okay. It's not linear. It can really catch you by surprise. You know, if you think about what we've had, Andre, since, say, let's go back to 22, like early 22, February 22. Let's say you bought, let's do a thought experiment and say you bought protection against declines in stocks in February 2022. And let's assume that you were in a coma and you're just waking up. And I have some news for you, right? You want to know if stocks went down or up since February 22. And I say, well, we have a war in Europe. The Fed has hiked 550 basis points. We've had the second, third, and fourth largest bank failures in history, and now we have a live war in the Middle East. You would think stocks would be down given everything that's happened. And this comes down to the massive amount of money in the system and the fact that corporations are really solid balance sheets and that there's just demand for financial assets and that growth has surprised on the upside. So in hindsight, we can explain why this happened, but the risks of the geopolitics are still very present. And you've seen it around Ukraine in the early days, how much of an inflation shock. So there's a risk there, Andre, and being long the real asset strategy is a way, in a sense, to protect for that risk in the portfolio.
Sebastian, I've got a lot more to talk to you about. I hope you come back, but also I hope your 13-year-old daughter gets everything she puts on that list for Santa Claus.
It's too much, Andre. By the way, thank you for following my commentary. I got to be careful what I say. It sounds like you listen to everything I say.
Because I've always liked to follow you.
Thank you.
Thanks, Sebastian. Hey, if you've got a question, maybe a comment about the show, we'd love to hear from you. Make it concise, make it piffy. Write us at andre@bennettcapital.com. Now, for a wrap-up on Wall Street. Now, according to a CNBC poll released this week of millionaires of how they see for the next 12 months looking for the economy, just about 40% see it weakening, 30% seeing it going stronger. And investing over the next 12 months, most will be in stocks at 41%, followed by short-term investments at 25%, and fixed income as bonds coming in at 18%. And this week, with the stock surging, those 7 stocks known as the S&P 500 as the Magnificent Seven, they are continuing their rise, all based in technology. But if you'd like to invest in these type of stocks but just can't buy all 7, there is an ETF that you can buy, this one ETF, exchange traded fund. It has all the stocks of those 7 S&P tech companies in them. It's called the Vanguard Mega Cap Growth with the symbol MGK. And for the year, it's up almost 44%. Now, that's a great lead-in to my guest for next week. We're going to be discussing the investing of ETFs, or exchange-traded funds, with Tim Urbanitz, the head of the Research and Investments in Innovator Capital. At Innovator Capital, they specialize in ETFs, and we'll discuss investing to get more bang for your buck. And finally this week, on Wednesday, was an anniversary for Apple. On December the 13th, 1980, Apple went public for you to be able to buy shares in that company. Apple closed today at $197 for the year. Now, Apple is up just over 52.5%. And Apple hit an all-time high today. So if you would have invested $1,000 when they went public on December the 13th, 1980, your return on an investment would be just over $2 million, a return of over 201,700%. Well, that's a wrap-up on Wall Street Wrap-Up. Starting Monday, we're going to be having only 9 more trading days left for the year. Our thanks to Sebastian for being with us this evening, but as always, we appreciate you for allowing us into your homes tonight. Have a fun weekend with the ones you love. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and always remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.